Amazon has partnered with a Chinese propaganda arm.
On Amazon, rumors are circulating on the internet that products you get from Amazon will show a tariff price tag next to the item.
Amazon is pulling back from the U.S. supply chain, not due to competition or regulation, but because of steep tariffs imposed by President Trump. A 10% tariff on all imports and a 145% tax on Chinese goods, announced in April 2025, have sharply increased costs, forcing Amazon, responsible for 40% of U.S. e-commerce, to shift operations to cheaper markets abroad. The move highlights a flaw in Trump's plan to revive American manufacturing. Instead of creating jobs, it's pushing companies and investments overseas. Bloomberg reports show U.S. imports down 20% in 2025, and analysts expect e-commerce giants like eBay and Alibaba to cut their U.S. supply chains by 30% by mid-2026. Amazon reacted quickly, restructuring over $13 billion in contracts within 2 months. The tariffs drove up prices on essential goods. Electronics alone saw a 25% cost increase. Facing unsustainable losses, Amazon slashed deals tied to high-cost imports and redirected operations to regions less affected by U.S. trade policy. This isn't a minor adjustment, it's a major shift. Contracts were canceled or renegotiated, and new supply routes were established. Bloomberg notes this reflects a larger trend of companies moving away from the U.S. market due to its unstable trade environment. Unlike the 25% tariffs in 2018, which companies could work around, the 145% rate on Chinese goods is nearly impossible to absorb. Smaller firms face bankruptcy, and even giants like Amazon are overhauling their entire logistics networks. Trump's policy aimed to boost U.S. manufacturing by making foreign goods less competitive. But instead of onshoring production, companies are simply moving operations elsewhere. The Wall Street Journal reports a 15% drop in U.S. import volumes in early 2025 as businesses sidestep the tariffs. This shift extends beyond Amazon. Supply chains are being redrawn, reducing traffic through U.S. ports and hitting trucking and warehouse sectors. While the administration defends the tariffs as leverage against foreign rivals, economists warn they'll cost U.S. businesses $50 billion annually, with little sign of domestic job growth. Amazon's changes don't bring production back to the U.S., they reroute it entirely. And while the company has shielded consumers from immediate price hikes, analysts warn that electronics and apparel could rise 10% to 20% by early 2026 if tariffs remain. The $13 billion restructuring is a stopgap, not a solution. The tariffs may weaken China's role in U.S. trade, but they're also pushing Beijing to strengthen ties elsewhere. According to the Financial Times, China is already deepening trade relationships in Asia and Europe. Amazon's pivot is just the beginning. Experts predict another $10 billion in supply contracts will be shifted by late 2025, further reshaping trade flows and reducing U.S. influence in global commerce. Amazon's $13 billion supply chain overhaul signals a major shift in global trade. As tariffs bite, other e-commerce giants like Walmart and Target are likely to follow, potentially triggering a lasting realignment that weakens U.S. influence over key supply chains. Trump's tariffs, meant to protect American jobs, are having the opposite effect. Companies are moving operations abroad rather than investing in the U.S. The lack of new factories or jobs at home suggests that protectionism may be backfiring, forcing companies like Amazon to focus on survival over loyalty to American markets. If this trend continues, the U.S. risks losing its central role in global trade as businesses turn to more stable, cost-effective regions. Amazon's move is a wake-up call, showing how fast global firms can adapt and leave the U.S. behind. Trade experts warn that by mid-2026, the U.S. could lose up to 20% of its share of global imports if tariffs persist. Behind the scenes, Amazon is quietly shifting away from American ports to new logistics hubs in Mexico, India, and Vietnam. As these countries boom with factories and distribution centers, U.S. ports like Los Angeles and Long Beach are seeing sharp declines. Container traffic in L.A. is down 22% in 2025 alone, according to Reuters, largely due to Amazon rerouting shipments to avoid tariffs. The fallout is severe. Fewer ships mean fewer jobs for dock workers, truckers, and warehouse staff. In contrast, Amazon is rapidly expanding in Mexico, especially in Tijuana and Monterrey. A Bloomberg report estimates a 35% surge in Mexican logistics facilities this year, giving Amazon a cheaper land route into the U.S. Mexico's proximity, low labor costs, and trade deals like the USMCA make it ideal. India and Vietnam are also emerging as key nodes in Amazon's network, offering low-cost manufacturing and government incentives. Vietnam's exports rose 18% in 2024, largely fueled by companies shifting out of China. India, with a large workforce and improving infrastructure, is becoming a major electronics and apparel hub. These aren't temporary fixes, they're permanent changes. Amazon's investments are spurring job creation and economic growth abroad, particularly in construction, logistics, and tech. Mexico's border cities are booming. Vietnam is drawing skilled labor into urban centers. India's logistics sector is growing 12% annually. Meanwhile, U.S. port cities are in decline. Every 10% drop in container volume cuts around 5,000 jobs in places like Long Beach, according to port estimates. With a 22% drop this year, the economic and human toll is mounting. Lost wages, layoffs, and shrinking local business revenues. The broader concern is strategic. The U.S. has long used its ports as leverage in global trade. But as companies shift supply chains abroad, that leverage erodes. A Financial Times report warns the U.S. could lose 10% of its global trade influence by 2027. In its place, Mexico, India, and Vietnam are stepping in as rising players. Amazon's foreign investments expose the limits of U.S. protectionism. Tariffs meant to bring production home have driven it further away. Countries like Mexico and Vietnam, shielded by trade deals, are benefiting while the U.S. loses ground. This shift may outlast the Trump era. Amazon's new facilities aren't stopgaps, they're long-term bets. While Mexico sees booming border towns and job growth, California's port regions face budget cuts, business closures, and declining public services. In Long Beach, officials report a 15% drop in port-related economic activity. Meanwhile, Amazon's factories are boosting Vietnam's GDP by 2% and fueling double-digit growth in India's logistics sector. The global trade map is being redrawn, and America is at risk of being left off it. Amazon's global shift reshapes trade and U.S. jobs. By mid-2026, Amazon is expected to rely more on Mexico than U.S. ports for its North American logistics, reducing traffic through Los Angeles and Long Beach. Experts predict this could cost 15% more port jobs, accelerating a broader decline in U.S. shipping hubs. As Guadalajara and Hanoi rise in importance, America's docks risk becoming obsolete. This isn't just a logistical adjustment, it marks a geopolitical shift. As Amazon moves operations to lower-wage countries, U.S. dock workers and truckers face growing uncertainty. Retraining options exist, but funding and urgency are lacking. Tariffs designed to protect American labor are instead pushing jobs overseas, exposing a gap between policy goals and outcomes. Mexico, Vietnam, and India are becoming vital links in Amazon's supply chain, strengthening ties with blocs like the EU and ASEAN. According to Brookings, these nations may align more closely with global trade networks, sidelining the U.S. in future agreements. Far from reinforcing U.S. dominance, tariffs may be accelerating its economic decline. By 2026, Mexico is expected to handle 30% of Amazon's regional shipments. India and Vietnam's roles in production will continue growing, cutting further into U.S. port activity. For Amazon, this realignment ensures global growth. For American workers, it raises hard questions about jobs and economic resilience. Retailers warn of rising costs and vanishing goods. Major U.S. retailers, Walmart, Target, Home Depot, Mattel, are warning that tariffs are driving up prices and disrupting supply chains. The 145% tariff on Chinese imports introduced in 2025 has inflated the cost of everything from clothing to tools. Walmart reports a 12% spike in consumer goods prices, while Target and Home Depot cite delays and vanishing inventory. Mattel faces rising production costs and delays, threatening access to affordable toys. These effects hit low-income families hardest. A 12% rise in prices at stores like Walmart could cost families hundreds of extra dollars a year. A Consumer Reports survey shows 30% of low-income households have already cut back on groceries. If tariffs persist, analysts expect prices to rise another 15 to 20% by late 2025, adding $1,000 to the average family's annual expenses and reducing discretionary spending by 8%. The Peterson Institute projects this could drag GDP down 1% by 2026. Though Amazon hasn't moved its headquarters, it's reducing its U.S. footprint. By expanding in Mexico and Vietnam, it's maximizing profits while distancing itself from the domestic economy. This signals a quiet retreat from the Made for America model. As supply chains realign, the U.S. faces not just economic consequences, but diminishing global influence. This was just the beginning. Hit that subscribe button and buckle up. Digital Garage has so much more in store.